Hey everyone, welcome to our second webinar. Today we're going to speak about audited financials and financial assurance issues. Today we have Alyssa Lucino, who's part of the ILF team. She's a guru at all this stuff, financial assurance, audited financials. So she's going to help out with a bunch of questions today. We also have a special guest, Mohammed Metwali. Mohammed works with many of our franchisor clients and does a bunch of audits with our clients. So he has a really good understanding of what's involved with getting financials in time, working with franchisors and getting financials. So part of this is really about, making sure that we get financials timely. We never want to be the franchisor that is, we have our FDD done and we're waiting on the auditor. A lot of times franchisors blame the auditor, but there definitely are proactive steps that we can take. It's not always the auditor's fault, but I can tell you Mohammed is very responsive and timely. So looking forward to getting some insight there. So
thank you, Brian.
Yeah, it's a pleasure. So just going through revisiting some of the goals that we mentioned on the first webinar, right? So we're preparing now for a great 2024 FDD, and this is about the entire series of webinar series. Avoiding dark periods and registration delays, enhancing your competitive edge and positioning compared to your competitors, really energizing your item 19, and that's going to be the next webinar, and we'll have more information on that. Avoiding the last minute frenzy where opportunities may be missed, right? That's really important when things are, crazy and hectic. There are a lot of opportunities that we don't take advantage of, which always causes a problem, and this is what we're trying to avoid, right? We want to do it in a structured way. We want to do it in a timely way. So this is what this webinar series is about, really getting ahead of it, not being one of those franchise systems where we're scrambling and trying to do things last minute. So I know this is a little boring, and I said, Mohammed, we have to make this really exciting. So, but really to get a full understanding of what's involved with audited financials and the financial assurance requirements, the topic that we're going to discuss today, we really do need some background as to what's involved as far as the audited financials themselves. So, Mohammed, could you briefly explain, just very high level, what some of the financial statements are that a franchisor would need on a typical basis?
Yeah, sure, Brian. I'm going to try to keep it short. I know accounting is boring, so I'm going to keep it short. But at the same time, I'm trying to explain what's needed and what is financial statement. So we basically have three financial statements. Those are the main. We have four, but you combine the fourth was the income statement. So you basically have three: income statements, cash flow, and balance sheet. The first one is your balance sheet. Balance sheet it's like taking a picture as of the year end. This picture will show your assets, your liabilities, and your equity, right? So it's very important when we're going to talk about equity later on, we're going to explain that. But balance sheet is basically taking a picture of your assets and liabilities and equity. Your income statement, this is your bottom line, your P&L, your profit and loss, very important statement. Your cash flow, this is the statements where you want to show what is your cash coming from. Is your cash coming from your operation? Is your cash coming from your investing or from financing? So for example, if you're taking debt, the majority of your cash is coming from debt, right? But if you're not, and it's coming from operation, so your cash will show that it's coming from operations. So those are the main three statements. We have members' equity statement that we sometimes add it to the income statements, but in my firm at least, we have it separately. One thing before I get back to you is, we have to put the footnote disclosure. So sometimes we only see the statements without the footnotes. You're required to have footnote disclosure, and basically the footnotes are just explaining some of these line items on those financials.
Perfect. Thank you so much for that.
Yeah.
And thanks for keeping it brief. That was great. So now, is this required for all? We get this question a lot, and that's why I want to emphasize that. Is it all entities that are involved with the franchisor, like parent companies, affiliate companies, vendors? Like whose financials are we auditing?
So we're auditing the franchisors as long as the parent doesn't guarantee any performance, right? So if it's just a franchisor's financial statements, but once that parent or the owner or the affiliate company starts saying, okay, I'm guaranteeing obligations, I'm guaranteeing any post sales like training, anything like that, then we're gonna have to put the franchisor statements along with the parent statements, and those are very important. So that's why we always ask, if does the parent guarantee anything? If it doesn't, then you're only required to put the franchisor.
Okay, great. And then there are some exceptions, right? And this is a general, a general kind of exception for brand new franchise systems. The federal government does alleviate some of that requirement as far as getting those financials audited, right? They call it the phase-in, meaning that it doesn't have to be audited on day one. But this does not apply if you're going to be selling in registration states. So a lot of people get that confused as well. So if you're going to be selling, even if it's on day one in registration states, everything needs to be audited. And like Mohammed just said, it's the franchisor company, unless the parent company or some affiliate guarantees the performance of the franchisor company. So everybody should keep that in mind. Another thing that also comes up, and we discussed this in the first webinar, the fiscal year end may be different, right? And that's something that I'm not going to go too, we're not going to go too much into that, but just keep in mind that it's not always the calendar year where those financials we're talking about. So a lot of times, you're going to have a fiscal year that's going to be different than December 31st, and the audited financials are based on that, on your fiscal year. So it's not always the case that we need it for the calendar year. So I just wanted to note that because we get that question a lot too. So here are the things. So like I said earlier, a lot of times, our team will finish an FDD. We've already been having conversations with our clients for months, getting updated information. So we have the FDD ready. We keep a blank where the issuance date is, and we'll hear back from our client. Well, we're waiting for the auditor, right? We're waiting for the audit. We can't do anything without the audit. Sometimes I'm not going to say it's never the auditor's fault. Sometimes it is the auditor's fault. This usually corresponds with tax season, and accountants get busy, CPAs get busy, and it's always something that that definitely comes into play, right? Everybody's got busy, so we're following up with the auditor and don't get the audit. But many times we can do things to help the auditor get the financials back in a timely manner, right? So this is what this is what the webinar series is about. Being proactive. We're not going to blame anyone else this year. We're going to take all the steps we can and try to get it done early. So one of the things that we can do, right, as a franchisor, gather supporting documents, right? Because the audit, everybody thinks of the audit as just financial information, but that's not the case, right? So Mohammed, in addition to financial information, what are some of the other things that you would need from a franchisor that they can start gathering in advance to help you facilitate the audit?
So we have basically a rule in audit where it says you can't have a number without documentation. So any numbers on your financials need documentation, right? From our world, at least from the franchisor's point of view, some of the most common documentation that you probably need to keep is like franchise sales. Once you make the sale, then we need the franchise agreements. If you have leases, if you have debt, one very common is like broker commission statement. Agreements. If you work with a broker and you kind of work out a commission, then that's going to be in an agreement, right? So we need those agreements. If you going into the audit expecting that we're going to be asking for this, and you kind of create a folder on the cloud or OneDrive or whatnot, and just keep those documentation. And simply when we ask for this documentation, you can just refer us to that folder where you keep it. Again, in most of the auditors, they use cloud, so they can set you up on the cloud and you can start adding those as you go, or at least before year end.
Great. So set up a Google Drive, set up a Dropbox or something, start putting those agreements in there, franchise agreements, bank statements, and it could be something as simple as sharing. Right, we use a Google Drive here. Share it with the team. but you want to make sure that that folder is ready to go.
Yeah.
We're not waiting for auditors to ask for it. We're going to be proactive this year.
Right.
Two, working with bookkeepers, right? So one of the things I know, there needs to be constant communication with your franchisor's financial team, which in this case, we're just calling them bookkeepers, but whoever's in charge of the books and the auditor, like they need to exchange information, constantly. So make that introduction right away. This way it helps facilitate that information going back and forth. Collect financial data, right? So they are, in addition to the documentation, they are actually going to need your financial data. So one of the things I think people get confused about is that they think the auditor is going to prepare the financial statements for them, right? And Mohammed, that's prohibited, right?
Yeah, we can really do that. We can assess was disclosure, and this is going to be already in the engagement letter, but you cannot prepare because it will be like self-auditing. So this financial data is coming from your bookkeeper. Those are like the balance sheet, income statement that we talked about.
Great. So don't expect your auditor to do the financials, right? We need to do separate financials. Auditor is just auditing them afterwards.
Right.
And then one thing that comes into play, I hear this a lot, our bookkeeping team is not up to date, right? And that may mean that you need a new bookkeeper or a new financial team, right? Someone who's going to be on top of it constantly. And, you want to make sure all your books are in order.
If I can add here one thing,
Sure.
Brian, real quick. So let your bookkeeper know that you need those financial by 120 days after your year end. So if you have a calendar year, let him know that you're going to need this by the end of April, because some of the bookkeepers have no clue that, there's deliverables. So talk to him ahead of time. Tell him, look, I need to close the books as soon as possible. So first week, second week of January, talk to your bookkeeper to get the financial data done. Because if you wait till March, now your bookkeeper has other clients that he has to file taxes or she has to file taxes for, and then it's gonna take a while to get your financial data. And auditors cannot start without this, financial statement. So I would highly recommend that you let your bookkeeper know that you're gonna need your financial statements as soon as possible.
Perfect. Great. All right. And then this kind of goes along with it. When would you say would be a good time to kind of start the process of, the audit? If you can give us some tips on that.
Sure. So if you ever wonder how, listed companies get their audit, those are early filers. So they have to file with the SEC by February 15th. How an auditor going to audit Google or Apple or Walmart in 5 weeks? We don't. We start early. So that means I don't really have to wait till December 31st to start my audit. No, I can do what we call interim testing, meaning I can test the first 3 quarters of the year, and then I will only left with quarter 4 to test it from January to April. So I can do the heavy lifting from October, November, December, and then when I get to January, I can start looking only at quarter 4, and if there is a changes, of course, in the first 3 quarters. But we really can start as early as June. If you have, you're making that sales and your financial statements are not easy, or you have a bad experience with the auditors, you probably have to want to start early. So discuss with your auditor about the game plan to do interim work, to do testing the first 3 quarters, and then the 4th quarter will be afterwards.
Perfect. And that would be a 3-quarter year audit, and that's kind of goes along the same lines, right? That's how.
Yeah. You audit up to September 30th, and then quarter 4 will be January to April.
Great. And this is something you mentioned as we were kind of discussing this topic on a different meeting.
Right.
You said draft an audit plan.
Yeah.
Right? Could you explain that a little bit? What that looks like?
Because now you have time before year end, you can discuss with your auditor about milestones. That's what we do, milestones. So I'm going to need your interim financial statements by, let's say, November 15th. I'm going to get you my request list by end of November before, we get on December and holiday. You give me, the supporting documentation by this date. So you will have like a plan, audit plan, where every date, is defined when I'm going to get your stuff and when I'm going to respond back to you. That way you don't wait till March to do that, because by the time you're in March, everybody's swamped, right? And nobody has time to work out a plan with you. So now is perfect timing to put that audit plan.
Great. Yeah, and going back to the first webinar, the goal for us, right? The goal this year, similar to kind of like Google does, right? We want to have our FDD issued and in the state's hands by February 14th, right? And we're using that as our cutoff date. So really want to be aggressive throughout this, and I think that's a great idea. Draft an audit plan, just go through those milestones, and this way everybody's on the same page.
Yeah.
I think that's a great idea. Speak with your attorneys, right? This is also something. There are also legal components to the audit, right? One of the things that I know a lot, all auditors need is the most up-to-date draft of the FDD at the time, right? We can't issue it without the audit because we can't finalize it, but we want to get it up to the date. We want to get the most update we can because an auditor needs that to do their audit. So speak with your attorneys in advance. Same thing. If you're not talking to your attorneys already, we're doing this. This is November 13th. You should be contacting your attorneys and setting up calls and kind of going through this process. There's also a legal letter component, and this goes through some of the questions that an auditor needs with regard to litigation or claims made and things like that. So. Even if one of the things I suggest we get them and we turn them around pretty quickly. We work closely with our clients all year, so we're pretty familiar with the lawsuits or potential lawsuits or anything like that. But if you're not working with your attorney on a regular basis, get that letter to your attorney as soon as possible so they can start reviewing it. Right? We don't want a situation where we're waiting for the attorney to get back on the legal letter, which should be done in a day or two. So that's really important.
And one thing to add here, Brian, because sometimes you get the FDD, you get the audit done and your legal team doesn't know about it. So the draft is not ready. So I can't issue my consent till I see the final draft. So I do the audit, but I'm still waiting. So it's better to connect your legal team with your bookkeeping, with your auditors, so they can work out the audit plan or the FDD renewal plan.
Yeah. Yeah, it's not, again, it's not just the financial numbers that are involved. There's a lot of documents, there's legal, there's opinions, there's a lot of moving parts to the audit. So you want to make sure the team is kind of working in sync with each other to make sure everything's being facilitated properly. So that's great. And I know this last one here, this one's, you made a really big point about this one, right? Communicate complex matters early. So why don't you give us a couple examples of what that means?
Sure. So we as an auditor hate anything that was not there in prior year. So the first thing we do analytics. So we see prior year versus current year and we see the changes, right? To assess the risk. If you have one of the scenarios or the situations where you have some complex transaction, M&A, if you bought another business or you took on a debt convertible or you took on any things that will require some researches, you have to let us know as early as possible. Don't wait till March to tell me, surprise, Mohammed, I got you an M&A. Because at this point, we have to consult those other parties. Like if I'm going to get a quality reviewer, and in March, it's very difficult to find that. So if you have one of those transactions, leases, that's a great example, leases. So we have a new standard now, 842, right? Leases, I'm not going to bore you with details, but leases will be accounted for differently going forward. If you have 5, 6, 7, 8 leases, don't wait. Don't wait. We need to know as soon as possible so we can have a game plan about how to audit those to make sure your accounting is done correctly and make sure the disclosure that required is in your financials. So any complex transaction or transaction, even if it's, you don't know what is complex, but a transaction that was not there and outside of your normal, day-to-day operation, I would discuss with your auditor. Definitely let him know ahead of time. Hey, I got this going on, and let's have a game plan for that.
Great. Yeah, and I've seen situations where the audit, everything's done, FDD's done, audit's done, and then this thing pops up last minute, and that delays us months.
That's exactly what happens all the time. You do all the financials, and then you got that one transaction that you have to wait for someone, either from his side, the accounting is not done right. So M&A, we need someone to go over the M&A, make sure your goodwill is booked correctly, make sure your valuation is done. And to find someone to do that for you in March, April is very difficult. But now, like if you started in November and you already know that you have this transaction, then you can find anyone to help you with this accounting if it's not done already. Plus, I have a game plan on my end as well. So once I get your documentation or your accounting, I already know what's going on ahead of time. So I have my audit plan set up. If I'm gonna need a quality reviewer, then I'm gonna get the quality reviewer to look over this ahead of time.
Perfect.
Yeah.
All right, great. So those are the proactive steps that we can take to make sure we're not waiting for our financials. We can issue early, go through the process, avoid dark periods, make sure we're closing all the deals. So this is really, all these kind of pieces have to flow together.
Right.
So now we're going to walk over to financial assurance requirements, right? So what is a financial assurance requirement? This is a big topic for franchisors, a lot of mystery behind this. So this is why we wanted to make sure that we make sure everything's clear for our clients, for the franchise industry, what that looks like, right? So a financial assurance requirement is a state-imposed condition to registration for risky, right, quote unquote, risky franchise systems, right? So so it's basically a condition that a state will put into place that basically says because a franchise system is risky, we're imposing this additional requirement that other franchisors don't really have to deal with if you're not risky, right? So it's a condition to registration. If you don't satisfy the condition, you can't get registered in that state. You can't sell franchise in that state, and it creates a lot of problems. Not every state does it. There's only a handful of states that this becomes an issue with, but they are important states. California, Hawaii, Illinois, Maryland, Minnesota, North Dakota, Virginia, and Washington. So those are the states that we're discussing and are at issue here. So what is risk? How does the state deem a franchise system risky? So there are generally two components. One is a time franchisor is operating the franchise system, right? Is it 1 day? Is it 50 years, right? How much time have they been operating as a franchise system? The other factor is financial strength. And how they measure financial strength? Typically, it's equity on the balance sheet that Mohammed was talking about earlier, right? So they're looking at one number, generally speaking, and that's the number they use as a benchmark. Some states also, in certain circumstances, look at working capital, but that's less likely. And usually, equity on the balance sheets is the key factor, right? So there's two different names, generally speaking, as far as if you're looking in your financials to see where that number is. If you have a LLC, a limited liability company, it's going to be called members' equity, and if it's a negative, it's deficit, right? That's in parentheses. And if it's a corporation, it's going to be called stockholders' equity, and that's if it's negative, it's going to be considered a deficit. So, Mohammed, if you could briefly explain kind of the differences between, when someone has equity and when someone has a deficit, what that looks like, and as simple terms as possible.
So as simple term as possible. So the accounting equation, remember we said when you taking a screenshot or you take a snapshot of your balance sheet, I'm taking a picture of your assets, liabilities, and equity as of year end. So the accounting equation is assets equal liabilities plus equity. Assets equal liabilities plus equity. So if you have $2 assets and you have $1 liability, now your equity is good, it's positive 1, right? But if you have assets 2, liabilities 3, now you have negative 1 in equity because the two sides have to equal each other, right? So that's when you get the equity deficit. Your liabilities is more than your assets. And that's risky. Why? Because you don't have enough assets to meet your obligations. Specifically, if you have, short term, we're looking at short term, then that's going to be another issue. But that's why you have the working capital. But from equity standpoint, your liabilities is more than your assets.
Great. And if you could just give us some again, don't go to, I know there's a bunch of this can get really complex, but generally speaking, like what for a franchise system, what are some examples of assets that would go and some liabilities that would go into that equation?
So like assets, we're talking about your cash, right? That's the most common assets. You have cash, AR, account receivables, other assets, fixed asset like PP&E, property, plant, and equipment. Those are your good stuff, your assets. The bad stuff, your loan. You have a loan, you have accounts payable, you have accrued expenses. Those are the liabilities. So make sure your cash, your receivable is more than your short-term or your liabilities, which is your loan, your accounts payable, and your accrued expenses.
Great. And when you say cash, would that generally be franchise fee revenue, royalty revenue?
It can be anything. This is the royalties revenue is coming in the income statement. So this is the income statement. When we're talking about the balance sheet, we don't know where's that cash coming from. We do, but it's not going to be shown. It's going to be cash coming, maybe owner's equity, owner's contribution to the business. Maybe you're selling franchises. There is a lot of factors that can contribute to that cash amount. But what we care here is you have enough cash or enough assets to cover your liabilities. So if you have $2 assets and you have $1 liability, then you're good. Your equity will be positive, and that's what they're looking for.
Okay, so and that's going to be an important distinction
Right.
in a little bit, because there's some ways that the equity could be I guess kind of established not just through traditional income for a franchisor, but other ways that cash number could be
Right. So your equity is two things, right? Your retained earnings or losses and your membership or members' activities. So two things that contribute to the equity. Those are the two components. Your retained earnings, this is income minus expenses. If you have losses, that's gonna make your equity weaker, right? And then owner's contribution and owner's distribution. So the more you contribute into your business, the more positive your equity will look. The more you distribute from your business, the less your equity will look tempting to, at least to states. So those two things you want to factor in. Make sure your liabilities under your assets, that not more than your assets, and your equity has either contribution or has positive profit, basically.
perfect. Okay, so the next question comes into play. We get this question so often. Are there specific rules, right? Are there, when they're determining risk, are there specific instances where, let's say the state of California will tell us, this is how much time we need to be in operation. This is how much positive equity we need in order to avoid financial assurance. So that's really the question. So the reality is no state really gives us a good picture or an analysis, by itself. There's no regulation that says, you need 200,000 in positive equity and you need to be in operation for 3 years, right? The statute doesn't exist. But Alyssa, right, we get a lot of feedback from, we represent over 300 brands. We file, hundreds, if not thousands of these applications with the states. We get a lot of feedback. So what we want to do is we want to try to figure out what generally states would consider when they're looking at this analysis. So Alyssa, from your point of view, what is typically the time frame that a franchise system has to be in operation, and what is the equity number that generally would be included?
Yeah, so I would say typically most franchisors are going to be a risk factor for the states for the first 3 years of operation. Those 3 years are key. They're looking to see if they can sustain the system, and the states want to see that you're going to be able to support the franchisees. So the first 3 years are really critical when it comes to a financial assurance being imposed. And most states want to see at minimum a positive equity number. Most of them want to see a high positive equity number. Some of them want to see 3 years of a positive equity number. So it really just varies based on the state. There are no set rules, like you said. It really is subjective to the state and subjective to the examiner reviewing the application.
Okay. But as a general framework, if we said if a franchise system is in operation for 3 years and they have above 100,000 in equity, that would be, for most instances, a good place where the states may start pulling those restrictions.
Yeah. Yeah, I would say that's a good gauge to start saying that they're not going to impose it anymore.
Okay. And what about the situation if it's year one? We have $1 million positive equity, but it's year one in operations. What do the states think about that?
It really varies based on the state. Some states would be, all they care about is what the number says on the statement, and they're going to let you, register without a financial assurance. But there are also some states that will still see that, well, you may have put a lot of cash into the account, but that doesn't mean you've been around for long enough that we still feel that you're not a risky franchise system. So they may still impose the financial assurance even with $1 million in the bank account.
Okay. Yeah, it would be great to have just rules on this, and this way, we can figure out what the examiners are trying to get across. It's understandable why they would do that, to protect their citizens in their state from franchisors that don't have the financial ability to work with them. But it would be great to have some guidance, like real guidance on that. One of the things we also want to do this year, we want to measure. I really want to kind of get to get a more narrow, in each state, and kind of see what comes back. So this year we're going to record information as far as, when the states impose it, and, the years in operation and the equity, and see if we can come up with a good metric that we can use moving forward. But generally speaking, this has been the experience of the firm, but it varies so often that it's not really easy to gauge. So let's assume that a state imposes a financial assurance requirement. Again, that's a condition where they say you cannot sell franchises in our state unless you do this, right? Unless something else happens, right? That's the condition. So there's a few different options as far as the conditions, generally speaking. And again, we're going to get to the differences in states. Some states won't allow you to use all the tools. Other states will, and so really depends on the state. But the most common way franchisors get around the financial assurance requirement is a deferral of the initial franchise fees, right? So basically what happens is the state says, franchisor, you're not able to collect franchise fees, so you have to defer them, right? So a franchisee keeps them, holds on to them, and they just basically don't pay them, right? So there's good and bad things about the deferral requirement. One, it's easy to do. Just have to add some language to the FDD. Usually it's the state addendum where we could just add, this deferral requirement, and that's really, solves the problem for the state. It's quick to get done, right? Very simple. It doesn't cost anything, right? Just your attorney just making that update and modification to the addendum. The cons, right? There are a few cons to this as well. Brokers, right? Generally speaking, brokers want to get paid on day one, the day they, the franchisee signs the deal. They don't want to wait, a year for the franchisee to open. And I did not mention that the fees are deferred until franchisee commences business, right? So that's an important distinction. So in certain circumstances, that could be a year plus, right? So the state says you can't collect those fees until franchisee opens for business, and that is the requirement. The rationale behind it is, well, franchisor fulfilled all their obligations pre-opening, right? They trained, they helped them get opened, so now they're less risky for a franchisee now that they have an open business. But brokers don't want to hear that. They want to get paid their commission, which is a problem. You're paying out-of-pocket expenses. Most franchise system will use the franchise fees to cover the costs of opening locations. Right, there's training, there's broker commissions, there's flying to locations, helping the build out. Right, there's a lot of expenses involved, technology, whatever the case is. So if we defer fees, franchisee doesn't pay anything. We risk spending money and not being able to collect it. There's also an issue with other fees. So a lot of the deferral requirements say initial franchise fees. But what does that actually mean? And we're going to get a little bit into that in a minute. But there are other fees, not just the $35,000 franchise fee. There's other things involved. Collection, we have to potentially collect this after the fact. What if franchisee opens, then they don't pay, right? What happens then? We have to collect them. We have to default them. right? There's a problem there. And then there's a risk of not opening. Maybe they never, open the location. We lose out our fees. But we spent the time. We lose out on our expenses, and then we're, franchisors stuck. So not a great position for a franchisor to be in on deferrals in most instances. But sometimes it works out. So one of the things I just mentioned, what about development fees, right? This is really important because it's not technically an initial franchise fee, but let's say someone buys a 5-pack, 5-unit location. They're going to open first location year 1, next 4 locations, years 2, 3, 4, and 5. What happens to those fees? Because they have to pay to hold that territory. Alyssa, what has been your experience with this as far as the development fees go with regard to the deferrals?
Yeah, so I've seen it be kind of subjective based on the state. So some states will say that you're allowed to collect that fee once the first location has opened. Other states have said that you may have to prorate that so that each respective development fee would be payable upon that respective unit's opening. For example, if you had a $50,000 franchise fee, development fee rather, you would collect $10,000 each time you opened one of your 5 locations, on top of anything that would be due also at the time of signing the actual franchise agreement. So it really just depends on what state you're looking to open in and what their specific rules are, but it varies.
Yeah, and it's a really interesting topic because a lot of, some of the language it just says initial franchise fees. Typically the multi-unit option, for example, would be in an item 5 fee, in item 5 as well. So that is technically included in that initial franchise fee designation, right? So it's a little bit of a gray area. Another gray area that comes up, equipment, right? It's a lot of or marketing packages, equipment packages. Those are item 5 fees, and whether or not we can collect them, and it's sort of like a chicken and egg scenario where, well, how are they going to open if they don't have equipment? But if you're as a franchisor, the vendor of the equipment, you're collecting fees and getting the equipment to the franchisee, right? That technically is an initial franchise fee also. So it creates a lot of ambiguity and a lot of issues there as well. So really, it's a really interesting area. Deferrals are sometimes ideal, in certain circumstances because they're cheap and, they're quick. So quick startup periods, generally we're not dealing with brick and mortar, right? A service business that could be operational in 3 months. We would have to wait until they open. So that's the 3-month period, not the end of the world sometimes. Those are typically service brands. When we're not dealing with brokers, right, because that commission issue is not a problem. So that's important. And then, like I said, no additional item 5 fees, right? All you have up front is an initial franchise fee, maybe a multi-territory, option in item 5. That would be, ideal for a deferral and in most instances. So it's not all bad. So then we have another option in addition to deferral, escrow of the initial franchise fee. And this has a lot of the same components as a deferral. This would allow a franchisor to find a bank in the state, and there's a certain approval process that you have to go through where the bank is going to hold the money. So the franchisee doesn't get to hold on to it like a deferral, but the bank can hold on to it. They act as escrow agent. And then same thing, once the franchise location opens, escrow agent will release the money to franchisor. And, there's, so it's the one benefit here over the deferral is that there's no collection concern, right? We're not going to have to chase a franchisee around and sue them and default them. Escrow agent, they have to follow their instructions pursuant to an agreement. And once that location opens, they have an obligation to release that escrow to franchisor. So it helps in that regard. Some of the downside, though, is time to coordinate with the bank. It's not as easy as setting up as a deferral, right? We have to coordinate with the bank. We have to get their approval. It's a process, and we have to go through that. Again, brokers, not a great thing because we're not getting the franchise fees. And again, it's a situation where if you want to work with brokers, you probably have to come out of pocket, pay the broker commissions, or else you're not going to get broker deals because most brokers are not going to wait a long period of time. And then same risk of not opening, right? Escrow agent has this money, the franchisee isn't open. Most of the escrow agreements will say that that escrow money has to go back to the franchisee. So again, we outlaid money, time, trying to open locations, and it didn't. We're not going to get the money, so that's a problem. It is ideal. Again, quick startup periods, no brick and mortar, service brands generally, no brokers, and no additional item 5 fees. So this is very similar to deferral. We're not getting the money, so it's treated as a, it's different. So then we go to the next, posting of a surety bond. Now this one is, to me, the most interesting. The surety bond essentially says if a state imposes a financial assurance obligation, a state will say, well, you can collect the fees as long as you find a surety, which is basically an insurance company, to post a bond on your behalf if you default on your obligations, right? So basically the surety is guaranteeing performance of the obligations of franchisor, right? So the pros to this is immediate collection of fees, which is great because we can collect it on day one. There's a bunch of downside to this too as well though. Number one, it's not cheap, right? It's pretty expensive, and it's a little complex as to how they come up with the expense and the cost. So Alyssa, if you could explain a little bit what factors a surety company would take into account when they're looking at the cost of the surety bond.
Absolutely. So there's a couple different factors that play into a surety bond. The first being the size of the bond. So how much of a bond did you need to obtain? A surety bond is a pretty simple equation in most states. It's just the number of anticipated locations you expect to open times the number of item 5 fees you have listed in your FDD. So if you had a $10,000 franchise fee and that was your only expense listed, and you wanted to open 5 locations, you would get a $50,000 surety bond. So that would be the first thing that they would look at, how large of a bond you would want. They would also look at the credit score of the person applying for the bond. So you would have to apply as an individual under your company, and they are going to be running a credit check against you for that bond to gain approval. And then another thing that they take consideration into is the history of the franchise company. So they may look for the financial statements of the company. They may want to see them, take them into consideration when applying for the bond. So those are like the 3 big points that they look at.
Okay, great. And it kind of makes sense. It's the surety company is also measuring risk, right? So if you have your credit score is not great, you're riskier to a bank or to insurance company, whatever the case is. If you're anticipating the number of locations, the more locations you open, the more risk. And the higher your initial fees are, their item 5 fees, the more exposure they have, right? So these are all kind of typical things that an insurance company would measure when they're measuring risk and figuring out a premium. Another con is that this is a bit of a gamble, right? Because the key term there is anticipated number of locations, right? So if I anticipate opening up 5 locations in California, but only open up 1, right? I paid a premium on what I anticipate of 5 locations. So it's a bit of a gamble, and it could go the other way as well. Maybe I think I'm going to open up 2, but I have an opportunity to open up 5, right? The gamble may be the other way, where I have 2, not enough surety bonds, which would create problems in that sense. And there's also an expiration. Typically, the bond's going to expire a year after it's issued. So again, I paid all this money for a bond. I didn't close any deals in that state. Now I have to think about so the bond expired. Now I have to think about renewing it. Also costs more money, right? So we get into this analysis where we have to measure the cost versus what we're going to close, the potential to close in those states. So there is a gamble and there's an expiration. Also a personal guarantee, which creates a bit of a problem if we don't perform. Most of the franchise systems that I've dealt with, that our clients, and they're going to perform. I think the risk of a franchise system not going through their pre-opening obligations is, to me, pretty minimal. But the insurance company, I probably wouldn't bet $1 million on it, but like the surety company would. But to me, it's a little bit of a risk. But the personal guarantee is also something else you have to factor in as a risk, right? Your personal assets, if you don't perform, may be at risk. Also, take into account your personal credit score. If your credit score is not great, that could increase the cost, or maybe you can't get it at all. And it is sort of a lengthy process. Alyssa, how long does it typically take from your experience?
Yeah, normally it takes about a month from the time that you submit the application to the time that we get hear back from the underwriters, because they do have to go get quotes from different underwriters. So it usually takes about a month, I would say.
Awesome. And sometimes it's a situation where, just like an insurance company, you may have to go to different underwriters, right? This one is expensive, or they don't approve you. You may have to shop around. So you definitely want to leave time, in order to get these finalized. You want to make sure you have enough time to do that. So it's really important. This would posting the bond, ideal for a longer startup period, right? Generally brick and mortars. Definitely, if you're going to be working with brokers and don't want to outlay those broker fees, right? That's because that's risky in itself as well, right? So you're measuring the risk yourself and have to go through that analysis. You have to be a little bit of a gambler, right? Risk averse. If you don't close those deals, you have to, you kind of have to take that risk. Also want to have good credit. That's important in this analysis. If you don't, you may have to have someone else guarantee some of those things. And one of the things that we run into sometimes is, a franchisor that anticipates opening 20 locations in a state. And now that number for that surety bond is very high, and it makes it very difficult to get. So generally speaking, it's a situation where we want to, close 3 or 5, right? That's pretty typical. And that's kind of what it's used for. If you go above that, you may run into issues just because that exposure is too high for the surety companies, and it may be very hard to get that surety bond for that many states, locations in the state. Another option is obtaining a performance guarantee, and we spoke about this a little bit earlier. This is basically when another company, whether it be an affiliate company, usually a parent company, would provide a guarantee for the obligations of the franchisor, right? So the good thing is we can collect fees immediately. The cons, we're shifting responsibility to another company, and it's an affiliate company typically, or a parent company. So it's a company that's owned by the franchisor. And also, if there may be there's going to be a requirement if you use this option, because there's a performance guarantee by another entity, the states are going to want the additional audited financials for the other entity that's providing that guarantee, right? Which then increases expense and increases time, right? So if we have to do another set of an audit for a parent company, that becomes problematic, time-wise and expense-wise. So it is ideal in certain situations when you have a multi-brand company, right? You have one parent company that has 10 different brands. This could be a great option, especially if this is a new brand to that multi-brand system, because generally speaking, the parent has financials to begin with anyway. So we're not going through those cons of additional time and additional expense. Also, if we're working with brokers, we're always concerned about that, not getting broker deals because shelling out the money in advance. In this case, since we get the money right away, it's great for when you're dealing with brokers. So it is good for certain situations, not great for everybody, but definitely an option out there. So mentioned this earlier, each state kind of handles the financial assurance a little differently. So we kind of just gave some examples of what each state looks like. So when we say no definitive feedback, right, which basically means, let's say if we get for California, for example, California won't tell us that you need up to $200,000 in equity, right? They won't give us that number. They basically have this vague statement that you're risky. We deem you risky, and we want you to do this, right? So California, for example, will direct the action they want you to perform to do, right? They may tell you to get a bond. They may tell you to do a fee deferral. They may tell you your bank statements are inadequate and you need to infuse cash, something like that. So usually in California, they'll direct you to what the situation is and what they want you to do to cure the financial assurance condition. Hawaii is usually only deferral, right? So we wouldn't be able to file a bond, for example. So the only thing we can do is in Hawaii, generally speaking, is a deferral. They have mentioned in a lot of our comment letters, whenever there's negative equity, they point that out. So that's something that's, a key there. So if we want to get registered in Hawaii and we have negative equity, we can assume we're going to be working with a deferral. But, again, there's no hard and fast rule, but generally speaking, this is what's been our experience. Illinois, they're one of the states that do mention negative working capital, right? And that's a little different than the equity position, but they also mention equity on top of that, right? And they have mentioned in some comment letters that if it's below 100,000, that they deem that risky, right? So we're trying to find a metric for each state. This year, we're going to go through and really kind of try to pin it down. Maryland, no feedback, right? You're just risky, general statement. And they have all options available. Same thing with Minnesota and North Dakota, right? They just say you're risky, do one of the 5 things, and you'll be able to get registered in our state. And Virginia, right next door, they don't allow bonds, right? So we can't get a bond for Virginia. They only allow a guarantee or a fee deferral, right? So again, as we're going through our analysis, we have to keep that in mind. Even if we want a bond in Virginia, we can't get it. Washington, very unique. They want 3 years of positive equity, generally speaking, and they have all options available, generally speaking, right? So you can cure the financial assurance condition by bonding, fee deferral, whatever the case is. But they have mentioned in comment letters that they want 3 years of positive equity. So that's really important. One thing that I want to mention, and this kind of comes back to the financials, right? So this is not necessarily a financial assurance issue, but some brands have in the past, and I'm not going to comment on how how this would be viewed, but some brands out there would infuse cash right before the audit gets done, right, to make that equity number fluctuate, right? And from an auditing standpoint, Mohammed, is there any issue with that from a audit standpoint? So if someone infuses 500,000 and then day after the audit, they pull it out.
I mean, there is no requirement to keep your equity at certain level for a certain period. You can basically contribute whatever you want, and especially if it's an LLC, and distribute what you want. It's just it creates a problem at your end for sure.
Yeah, and so a couple things come into play. We want to make sure that it's never perceived, and there's not really no rule on this, but we don't want to perceive that as deceptive, right? Potentially, a plaintiff's attorney could say that. And Alyssa, this has come up in some of the states where some of the states will they'll comment on something like this. So from your experience from the state level, what's been your experience with that?
Yeah, they haven't specifically said upfront if there's an issue. So if whatever we provide on the audit during the application process, they're not going to see like what we possibly put in or when we put that money in. They're just going to see it the day we submit it. If they do feel like it is too low, they may request you to infuse more cash in addition to having other financial assurance requirements. So if you only put a small amount in, they may ask you to put more, but they haven't specifically commented on the date in which you put the money in and the date in which you pull it out. That's kind of subjective up to the individual person.
Okay. Yeah, and I have seen on some comment letters where they say, you have to infuse cash and you have to keep it in for the whole term or something like that. So sometimes it's state directed where they say you need to keep that in, but generally speaking, they don't really mention it other than that, right?
Mm-hmm. Correct. Yeah, they may ask you to provide, if they did ask you to infuse cash, they'll want a redacted bank statement. They want a letter from the franchisor stating that they'll maintain that balance. They want a letter from an accountant stating that they can confirm the money was deposited successfully. So that would all happen after the audit was issued. But that's just for an ongoing purpose. They may want more money included in the bank from what you already put in.
Great. Yeah, and generally speaking, infusing cash is 100% acceptable, right? We can, we can put an you can get equity. Make sure you tell Mohammed about it or your auditor about it. You get someone loaning you money to put in there. There's zero wrong with that, and there's never an issue. So that's one way of avoiding the financial assurance requirements where that equity number, right? We're now increasing that because, like Mohammed said earlier, it's not necessarily tied to a royalty, income or franchise fee income or anything like that. That equity number is not based off of any particular asset in itself or any cash, in itself. So just something to keep in mind as we're going through this. Couple other things. Whenever there's a potential financial assurance, issue, there is a special risk page. You may have to add a disclaimer there saying that, we have negative equity or something like that. So just pay attention to that. It's a couple pages into your FDD. So if you don't see it there, mention that to your attorney. We want to make sure we're disclosing whenever necessary. We have to disclose that up front. Also, this is something that, we really preach here at Internicola. Have a bond financial assurance plan in place, right? We want to do this proactively. We generally know, and based on the analysis, we'll know what our financials look like. We don't want to be waiting. The worst thing that can happen is that we have a couple deals pending in Delaware. I'm sorry, Maryland. Let's say use Maryland for example. Then we have we submit it. We know we're going to be under Maryland's requirements. Again, they don't give them, but we know our financial condition could be deemed risky. I want to be talking about that now. So if we do have to have a bond, and because we have 3 pending deals in Maryland that are waiting on registration, we don't want to wait till we get the comment letter back, because now we waited some time to get the comment letter back. Now it's going to take some time to respond to the comment letter. Now we're just shopping for a bond. Again, it takes a month to get the bond. So now those deals are now in jeopardy, right? We want to start talking about that now and start putting our clients in front of a bonding company now. So this way we can get the bond right up front, and especially when we have pending deals. So I want to have a financial assurance plan in place for the brands that need it. Some brands don't. They've been doing it for years, and our financials are great. They don't have to really worry about this. But for the startup brands and the brands that sometimes there are surprises on the financials that they don't look as favorable as they should or could. But we want to look at this now and have this conversation now up front. So again, I thank everybody for whoever's on. Thank you for coming on. If you are on the live broadcast, you can email Melissa. Melissa, if you want to go back to that prior slide, just so they have your email address, mb@businessandfranchiselaw.com. We can provide some more of our t-shirts. They're really comfortable. I have 1,000 of them, I think, and I wear them every day. So feel free to reach out and get some free stuff as a thank you. Any questions? All right, Ron. Okay, how do they look at lease assets, deferred revenue, intangible assets, very large receivables compared to revenue? I think this is a great question for Mohammed. If you can shed some light on that.
Sure. So we'll take it one at a time. Lease assets. I'm sure you're around here, probably talking about the new standard. So it really, if you look at the balance sheet, your lease assets and lease liability will wash out. So if you recall, we said assets equal liabilities and equity. So if you add one in your assets, you're adding one in the liability, and that wash, right? Deferred revenue is the same thing, because once you have what is deferred revenue? Deferred revenue when you collect those initial franchise fees, but you cannot recognize them as revenue. So you put them like in a parking. Well, that parking is in liabilities, unfortunately. That increase your liabilities, but it will also get offset by adding the cash that you collected from the franchise fees. So that's, again, the impact here is, from my side at least, was a wash. There is no impact. Intangible assets, that's gonna increase your assets, but they're kind of tricky from my side. Of course, you have to go through valuation and whatnot, but those are, yes, that can have a positive equity. very large receivable compared to revenue. Same thing if you have AR, that's going to increase your assets as well. I guess what if you know we can put it into two things. If that what really hurt you on the equity side, if you dry up your equity by pulling cash out of the business, or you have a huge loss. When you have a huge loss, especially when you're just starting and you're not contributing enough or distributing the cash out of the business, that's going to lead to equity deficit. But if you have just like you said, deferred revenue, that deferred revenue is coming from sales. So it's going to be you're increasing your assets and liabilities. Intangible assets, same thing. And the ROU or right of use assets or the leases, the 842 is the same thing. So the two things you take from here will be don't dry up your cash. Make sure you have enough assets. And if you have bigger loss than you expected, try to contribute more funds to cover that.
Awesome. Thank you very much. And Melissa, if you want to get in touch with Mohammed, Melissa just posted Mohammed's contact information. So feel free if you have additional questions, if you want to inquire about
Absolutely.
the 2024 audit, or if you need info, feel free to reach out to us. We work. Mohammed works with a bunch of our brands. He's great. So yeah, happy to share the information if you don't have the information on the chat. Yeah, that's great. So any other questions or anything like that? If anything comes up, by the way, feel free to reach out to any one of us. And you know, we've been in contact with our clients, just trying to get in that process going. We've been talking about renewals since June, July, right? This is a constant thing for us because it's so important for our clients, making sure we're not blowing deals and making sure that we are responsive and we're doing everything we can in our power to get registrations done as soon as possible. Please join us at our next webinar. This is going to be on Monday, December 11th. The topic is going to be energizing items 19 and item 20 for explosive growth in 2024. We're going to cover topics, relationships between items 19 and 20, getting creative with item 19, which I don't think enough franchisors do, understanding perspective, franchisee mindset. Again, we want to know your audience and get in their mind. Working with advertisements as it relates to item 19 always causes a problem for franchisors. And then just a basic understanding of item 20, what needs to be included, what are transfers, what are ceased operations. So there's a lot of great information on that. So just want to thank everybody for joining us again today. Appreciate it. And
Thanks for having me, Brian.
And thank you, Mohammed. Thank you, Alyssa.
Of course. Thank you.
Bye-bye.